Welcome to Next Gen Invest Global. It's Saturday, March 28, 2026, and we're jumping right in today because a major geopolitical crisis is sending a massive shockwave through the global economy. We're going to break down all the data behind this market turmoil.
So, the first and most important number you need to know today is 119. Brent crude oil just spiked to $119 a barrel. This indicates a severe energy supply shock is hitting the global markets right now. And believe me, this isn't just a minor fluctuation. It's a jolt that's being felt everywhere.
So what's behind this? Well, this huge price surge is the direct result of escalating geopolitical tensions. Energy markets are basically pricing in a long, painful disruption. So let's unpack the market's immediate and very, very sharp reaction.
As you might expect, equity markets have responded negatively. We're talking about a classic risk-off move. The S&P 500 has tumbled 6% since the conflict began, wiping out a ton of value as investors, just dial down their risk.
Okay, so what is the real driver behind this shock? The data all points to one place, a critical bottleneck in the global energy supply chain, a choke point.
The Strait of Hormuz, to put it simply, it's a non-negotiable transit point for the world's energy. We're talking about 20% of all globally traded LNG passing through this one narrow waterway. It is an absolutely vital artery connecting the huge producers in the Middle East to, well, the rest of us.
And here is the truly crucial point. Shipping traffic through the strait has plunged by 90%. Let that sink in. 90. That's not a slowdown. That's a seizure. This single data point, this is the epicenter of the supply shock that's now reverberating across the entire globe.
And look, this disruption isn't just about oil prices. It's forcing a major and probably pretty painful rethink among the world's most powerful central banks. Why? Because they're now facing a brand new battle with inflation.
Just look at the scale of this change in Europe. It's stark. The European Central Bank was forced to dramatically revise its 2026 inflation forecast upwards, from 1.9% all the way up to 2.6%, and they're pointing the finger directly at the conflict's material impact.
And you guessed it, it's a pretty similar story over in the United States. Any hope for the Federal Reserve to cut rates in 2026 has, well, it's pretty much evaporated. This energy shock just completely complicates the path forward for monetary policy, and it puts the Fed in a very, very tight spot.
Now, before we dig into how all this is hitting different asset classes, it's really essential to state that this analysis is for informational purposes only. The investment information, comments, and recommendations here, they're not within the scope of investment advisory.
Okay, so with that macroeconomic backdrop, how are different asset classes actually doing? The data reveals a really clear and pretty classic divergence.
What we're seeing is a textbook risk-off rotation. Equities are definitely under pressure, especially in Europe because it's so exposed to energy price shocks. But on the other side of the coin, commodities are rallying. Oil is up sharply because of supply fears, obviously. And then you have precious metals like silver, which is benefiting from both safe haven demand and its industrial uses, having a remarkable year. It's up 15%.
And if you want to see just how extreme the situation is getting, get this. Bank of America is now forecasting a potential silver price of $309. I know, it sounds extraordinary, but this is based on their analysis of historical gold-to-silver ratios during periods of really intense market stress. Crazy stuff.
So what in the world are you supposed to do? How does this translate into an actual playbook for investors? Let's take a look at what some of the top institutions are saying.
The message from the BlackRock Investment Institute is, well, it's unequivocal. It's time to be cautious. They say their core strategy right now is to reduce what they call tactical or short-term risk exposure until things calm down a bit.
So what does dialing down risk actually mean in practice? Well, for them, it means moving to a neutral stance on broad markets, like U.S. stocks. But, and this is important, this isn't about selling everything. BlackRock still sees opportunity in long-term structural winners. Specifically, they're favoring the infrastructure behind the AI megatrend, semiconductors, power, and data center assets.
But then JP Morgan adds a really crucial layer of insight here. Jamie Cramer reminds us that, while it's smart to be cautious, it's just human nature to sell when things get weak and buy into euphoria. That's when mistakes happen. They're saying that these moments of acute volatility and fear, well, they can actually create some really big opportunities for disciplined contrarian investors who are willing to look past the short-term noise.
And all of this leaves us with a final and pretty crucial question for you to think about for your own portfolio strategy. In a world like this, an era of supply shocks and geopolitical risk, how does the very definition of a safe asset change? What does it even mean anymore?
If you found this breakdown valuable for navigating what's happening right now, make sure you subscribe to the channel for more data-driven market analysis. Oh, and like this video and share it. It really helps other people make sense of these challenging markets. Thanks for tuning in.